for the 7 and 8 figure entrepreneurs that we talk to here at Nomad Capitalist who want to go out into the world and create a low tax lifestyle or even a zero tax lifestyle, there's often one key element that goes overlooked. I'm going to tell you what it is and how to avoid it. Hey guys, I'm Andrew Henderson, and if you'd like to learn how our Nomad Capitalist team can help you create your holistic offshore plan, you can learn more at nomadcapitalist.com. There's one thing that I see from time to time that is one of the most common, if not the most common reason that people's offshore plans fail. And in this video, I'm going to give you a rather simplified version of exactly what this series of laws is about. But the thing that goes overlooked is what are called CFC rules, or Controlled Foreign Corporation rules. You see, a lot of people start their journey by researching something called flag theory, or the 5 flag theory. They see the decades-old strategy of planting different flags. You have a bank account here, you have your assets here, you have your residence here, you have your citizenship here. It's different places. It's what we talk about at Nomad Capitalist. Go where you're treated best. But one area that I think is a little bit confusing for some folks is it says, have your company in a tax haven. Well, that's great, and there are still some tax havens around. I've talked not so long ago about what I call the death of tax havens and how the industry is totally changing. Onshore is the new offshore, all of that. But when it comes to CFC rules, what has dramatically changed since flag theory was invented, and even just in recent years, is the idea that if you're running a company from a country, that company may be deemed to be basically a local company. So let me give an example. Here's a common situation that a lot of people who are new to offshore don't understand. They don't want to pay taxes. So they're sitting in, New York City. And they'll call one of these guys on the internet who is based in the Seychelles, and they'll call the weird Skype number, and they'll say, hey, I'd like to get a Seychelles company. Terrible idea, by the way, for most people. I want to get a Seychelles company to not pay tax. And they'll ask questions. Hey, I hear there's no tax on a Seychelles IBC, International Business Company. Yes, sir, that's correct. I hear I can do this, I can do that. Oh, absolutely, sir, that is correct. And they say, wow, what a great way to pay no tax. Why isn't everyone doing this? Well, why isn't everyone doing this is because the US government and most other developed world governments have figured out that, yeah, if they allow that, everyone would do it. So they have a series of rules. Now, there are plenty of other rules, and different countries call it different things. There's mind and management, there's permanent establishment, there's all kinds of different criteria. So this is not the main one, but this is one of the main ones. But basically what it says is, if you are controlling a foreign company from their territory, the foreign company, for the purposes most people are looking for, might as well not exist. Okay? So if you are a US resident, if you're a US citizen, and you have a foreign corporation, you're required to file, for example, Form 5471. You're required to report the existence of that company. If you are a US taxpayer, you're required to pay tax on your worldwide income. Now, we're not talking about expats who live outside of the United States. I'm saying if you live in the United States, you have to pay tax at the full ordinary income tax rate. And so if you're running a Seychelles company from the United States doesn't say, oh, that's great, please don't pay us. You found a really easy workaround. They say, no, great. Now that company is going to be treated like any other company here. And this is the mistake. Now again, I'm making this oversimplified. This is not tax advice that applies to everyone's situation because there's a lot of minutia that's involved in this. There are lots of different criteria that you have to satisfy to make sure that your offshore corporation really gives you the low tax or zero tax benefits that you want. It's not just CFC. But this is an area that I see people get into trouble with. For example, I've told this story before. Had some folks come to me. Hey, we moved our company offshore, and we've been living offshore, but we never got around to canceling our tax residence in our home country. Well, if you're still paying taxes in your home country, that means the offshore company gets sucked into the net. Because again, most Western countries have what are called residential tax systems. The US has a citizenship-based tax system where no matter where you live, they try and nail you, and it's a matter of planning to reduce the taxes. Americans can still reduce their taxes offshore. But every other Western country, Canada, Australia, UK, if you live there, you pay tax on everything that you earn in the world, subject to some credits and stuff like that. So if you live in Australia and you have an investment in, let's say, the Republic of Georgia, where your residential rental income is taxed at 5%, well, surely the tax where you live is higher than 5%. They're going to tax you for the difference. And if you have a company that you're running overseas, they're going to treat it largely the same way. Again, oversimplification. So the point is, there's a quadrant that has to be satisfied when you want to legally reduce your tax overseas. You have to look at both yourself and you have to look at the business. You have to look at where you're leaving and you have to look at where you're arriving. And if you can't satisfy and rectify all four of those parts of the quadrant, then you're probably not going to have a very effective tax plan. So it is possible, including for US citizens, to go overseas, to go where they're treated best, and to keep more of their own money from their business. Those folks who came to me, yeah, they could have legally paid zero if they had structured their company properly and if they had looked at not just the company side of things, but their own personal side of things, where they as the directors, they as the shareholders, had an impact on the corporate side. These things do not exist in a vacuum. And so it's possible to be out in the world and pay 0% or 5% tax in your company. I think that's a great way to get at a competitive advantage. But the government does not let people just sit around on their own turf, or have tax residents on their own turf, or have connections to their own turf, and just let you go and keep your money for them. It's not that simple. You need a better plan. If you want to be tax-free, you need to understand CFC. How can Nomad Capitalist help you? 4 ways. Number 1, subscribe to our channel and click the notification bell to make sure you get our new video every day. Number 2, get a copy of Nomad Capitalist, the book. You'll learn a lot of my personal experiences over a dozen years of studying this stuff, as well as exactly some of the strategies that you can use to build your Nomad Capitalist plan. Number 3, if you're not sure where to start, but you want to come and learn from my team and I, you want to come and mingle with like-minded people, learn more about our live conference, Nomad Capitalist Live. It's coming up soon. And number 4, if you want some help right now because you've got a burning issue, you need something solved, you want to lower your taxes, get a second passport, or build the Nomad Capitalist lifestyle of your dreams, go to nomadcapitalist.com and click on Become a Client.